There's an economic paradox playing out across the United Kingdom. As hiring demand cools and the job market loosens in the wake of pandemic turmoil, one might expect wage pressures to ease. And yet, the opposite seems to be true. Pay rates are climbing at an accelerated clip, with lower wage sectors seeing the biggest increases. According to data from the job site Indeed, advertised wages in Britain rose 6.5% in the year through May, with fields like childcare, retail, and hospitality clocking gains over 8%. Part of this surge can be attributed to the government's 9.8% hike in the minimum wage back in April. But it also reflects an underlying worker shortage that has persisted well after the worst of COVID. For the stodgy economists at the Bank of England fixated on their 2% inflation target, these heated wage trends are cause for consternation. By the central bank's calculus, such rapid pay growth is fundamentally incompatible with their price stability goals. The worry is that continued upward pressure on wages will bleed through to broader inflationary forces, embedding higher costs throughout the economy. Their anxiety is understandable. After raising interest rates aggressively over the past 18 months to cool rising prices, yielding some of the highest borrowing costs in 16 years, officials were likely hoping for some respite on the wage front. But the latest labor market tea leaves suggest their battle is far from over. Despite the fact that hiring demand has cooled significantly, there remains some residual tightness in the labor market, said Jack Kennedy, a senior economist at Indeed UK. That's particularly true at the lower-paid end. It's something that's going to complicate things for the MPC. The MPC, or Monetary Policy Committee, is the arm of the Bank of England that sets interest rates. And Mr. Kennedy's point cuts to the heart of their current dilemma, even as overall job vacancies resume a downward drift. The worker shortages that had fueled unsustainable pay hikes haven't fully dissipated. It's a maddening disconnect that could force policymakers to leave interest rates higher for longer. The roots of Britain's worker woes run deep. First, there's a startling dearth of labor supply. Roughly a quarter of the working-age population is economically inactive, a statistic not seen since 2015. Many have likely dropped out due to lingering health issues and long COVID. Meanwhile, long-term sickness absences have reached an all-time high of 2.83 million workers. These missing millions have battered sectors that traditionally rely on lower-paid employees. Following Britain's messy divorce from the European Union and the government's restrictive new immigration policies, it has become far tougher to backfill vacant positions with foreign workers. The salary threshold required to obtain a work visa was raised by a whopping 50% last year. So nursing homes, restaurants, retailers and others are left scrambling to lure workers from an ever-shrinking domestic talent pool, often by dangling higher and higher wage offers. That's disproportionately impacting lower-paid sectors, which find it harder to fill that talent gap with overseas workers after Brexit, Mr. Kennedy explained. It's an economic catch-22 with no easy solution. Immigration restrictions may appeal to those eager to bolster job prospects for native workers, but without an adequate supply of labor, the inevitable outcome is more acute shortages and higher pay for the remaining workers, both symptoms of an overheating economy that the Bank of England is desperate to tame. Conversely, pursuing a more open policy on foreign hiring could help alleviate the worker drought. But that risks inflaming cultural tensions around immigration, no small political matter in post-Brexit Britain. Indeed's data showed foreign interest in UK job postings rose 40% above pre-pandemic levels through May, with searches concentrated in high-skill fields like technology, healthcare, finance, and engineering. The incoming Labour government may help shape the path forward. Polls strongly favor Keir Starmer's opposition party in the upcoming July election. And while the economic platform remains somewhat opaque, their perceived business-friendly stance could restore some more business confidence post-election in terms of an end-of-the-wait-and-see attitude that some employers might be having, according to Mr. Kennedy. A Starmer-led rebound in corporate optimism and hiring could very well exacerbate existing wage pressures by further depleting the limited worker pool. Ultimately, no matter the political stripes of those in power, generating an adequate supply of labor through immigration reform, skills training, or other means must be an urgent policy priority. For until Britain's systemic worker shortages are resolved, the pernicious wage price spiral will continue vexing the Bank of England. Interest rates may need to stay elevated for the foreseeable future to restrain spiraling labor costs. It's an economic conundrum emblematic of the fraught post-pandemic recovery. Too many jobs chasing too few willing workers. Those looking for a swift return to the halcyon days of low inflation and cheap money would be wise to temper their expectations. The specter of stubborn wage growth haunting Threadneedle Street is unlikely to dissipate anytime soon. In many ways, it is the unglamorous final act in Britain's long Brexit saga, still playing out nearly 7 years after the original vote.